Hey everybody, JJ here. You're watching Bull Boom Bear Bust. It is Sunday night, February 16th, and I'm back from a little mini vacation. I don't believe in taking very long vacations. I was only out for a few days, but I appreciate you coming back to this channel, all the bulls and bears out there, and everyone in between. As we continue to watch this economy expand, and it's a debt expansion, unfortunately, it's not real growth. Now, they may tell you that growth is happening and they'll point to GDP numbers. But remember, a big part of GDP, the number that's floated out there, a big part of that is consumer spending. And what's being done right now is they're having to keep the banks propped up or liquefied in order to keep lending to both corporations and consumers. If either one stops, then the debt illusion starts becoming clear that it's a fraud. Now, corporate lending, a big part of the debt that corporations are accumulating, unfortunately, is going towards stock buybacks, and that's one way to keep the stock market pumped up and also a way to keep some of the pressure off of the Fed. Unfortunately, a lot of these stock buybacks are going to the already wealthy individuals, not all of them, but most of them, as we see just massive selling on the inside, insider selling. Will we ever see any sort of crackdown against this type of operation, which should be illegal? I doubt it. So we still point to the consumer as the key to keeping this illusion alive. And we know the consumer on average is continuing to get further and further into debt. That doesn't stop. It's simple that the wages are not keeping up with the debt that's being accumulated. And it's a combination of a few different things. We have foolish spending. A lot of people, if you look at consumer confidence is still high. Even though a lot of people are living paycheck to paycheck because people have just they've become accustomed to being in debt. It's the new normal. So maybe you let me know why this is, but maybe people just think that someday they'll get out of debt, or maybe they think that everyone else is doing okay and just they're the only ones in debt. It's hard to tell why someone would be confident in this economy when so many people are living paycheck to paycheck and the masses are under just enormous amounts of debt. Not everyone. You do have the top 10% that are typically doing pretty well right now. They're usually the higher ups in corporations. They're politicians, people tied into the banking system, people that have a lot of investments in stocks. So we know the stock market's in ultra hyper mode as far as pumping up the bubble. But let's get into some recent news that points to the key for this economy, which is the U.S. consumer. And things are not looking so good. And in fact, many are saying the debt nightmare is unfolding right now. Our first article comes out of NPR. U.S. credit card debt hits all-time high. We talked about that a few episodes ago. Nothing new. But also overdue payments are rising, and especially for young people. So we'd like to look at trends including bankruptcies and late payments. And this could be where it starts. This is the beginning of a delinquency trend, and it starts with the younger people. Why? Because they are the most indebted with the college loan debt. And a lot of graduates are not getting jobs that are paying enough to keep up with the cost of living and the high home prices and all the things that go up when the bubble economy is being expanded like it is right now. And I'm going to read a little bit of an excerpt out of this article. Americans owe nearly $1 trillion in credit card debt, and that's an all-time high, according to a recent report out of the Federal Reserve. And delinquencies and overdue payments are rising, especially among young people. And if we look at the 18 to 29-year-olds right now in the U.S., 10% of them now have credit card debt that's 90 days or more delinquent. Right, and as stated out of this article, that's a very big red warning light on the dashboard. If the economy is an engine, this is a check engine light. You might want to pull over or drive to your nearest repair facility. Unfortunately, the mechanics in this economy are going to be the Fed, who are going to pump in more debt and really don't know what's happening behind the scenes, but we know they are buying assets off of the banks. They're monetizing the debt. And this very likely is a way that they're keeping banks lending, even though if banks really had true skin in the game, if they weren't being backed up by the Fed, banks would likely be pulling back on the lending right now because the consumer is in such a bad position. But general standard banking has been thrown out the window. Of course, not everybody's going to get a loan because that would be too obvious, but banks are really allowed to loan right now to consumers that they really shouldn't be lending to in many cases. Okay, this article also goes on to state some of the other numbers that we talked about in previous videos, and that's also that 20% of student loans are also more than 90 days or more delinquent. Right, that is huge. So 1 in every 5 student loan debtor is 90 days delinquent. Just think about that. Or worse, it's 90 days or more. These people could be 5, 6, 7 months behind on their loans, but at least 90 days delinquent, 1 in 5 students. That's pretty astonishing. Also, another report, and this one is out of salaryfinance.com. A study actually has found that 32% of people making over $100,000 run out of money between paychecks. Right? And this is supposed to be the greatest economy ever, but yet people make $100,000 or more. 1/3 of them is running out of money. We usually think of people running out of money, people living paycheck to paycheck. We usually think of them as the lower income, the middle class. But now it's people making $100,000 and more. And once you get into that lifestyle of making 6 figures, you typically want the nicer house, you want the nicer car. But what a lot of people, in my opinion, a lot of people are not realizing is that those come with extra costs that never stop. You have the higher tax base, you have higher insurance costs. Keeping up with the Joneses could really come back to bite a lot of these people who want to be seen in the nice car. They want to buy the biggest house that they can get financed for. Combine that with the maintenance and the upkeep and all the other inflationary aspects of just life right now in this economy is catching a lot of people by surprise, even people making 6 figures. We're going to go ahead and link to this study as well. And here is a chart here out of people in brackets, income brackets, sorted by income, people that run out of money between paychecks. And of course we see less than 15,000, they are the leaders. 15 and 25,000 also, about 40% of them run out of money between paychecks. And it's pretty interesting. It dips down a little bit, but as we get into the 6-figure club here, the 6-figure bracket, we see still over 30% of those people run out of money between paychecks. So a lot of people, again, living beyond their means. People have trust that the economy is improving and it's going to be better down the road, even though we have a massive rescue operation happening right now in the banking system. But see, most people don't realize that. You're not supposed to know that. It's not talked about very often on the news. What is talked about is, hey, look at the stock market. Isn't this great? The economy's fine. Look at the unemployment number. It's near 50-year lows. Look over here. Don't look over here at what's keeping this economy flowing, and that's basically more debt, banks being propped up, and it's only a matter of time now. I still think the goal for this administration is going to be the end of 2020. They have to get through. That's the finish line, in my opinion. I know some of you down in the comments have different opinions on the time frames. A lot of you said that the economy was going to fall apart by now. And maybe you're right. If you look at the real numbers, the economy is falling apart. My opinion is just because the banks are being propped up, that it should not be looked at as a sign of a good economy. But still, the masses aren't awake to the financial system rigging that's happening right now. So we have to look at that because consumer confidence is a major, major component in keeping consumers spending. Once consumers are scared and decide to pull back on their spending, that's when the big job losses occur. And that's when it becomes obvious even to the most casual bystander of these markets in this economy. Once massive bankruptcies and layoffs begin, that's when everyone notices it slaps people right in the face. Right? You don't have to watch financial channels or dig into deep news about deficits or delinquencies and all those things to realize it, once that happens. All right, also keep going up to the higher income brackets. Over $200,000, still over 30% of them run out of money between paychecks. So as you can see, making 6 figures or $200,000 or more even still isn't enough. People want to stretch their income to the limit. That means getting qualified for the biggest possible mortgage, buying the biggest house, buying the most expensive cars, right? A lot of people are out there just seeing how much can I get qualified for? How much of a loan can I get based on my income? Instead of saying, hey, even though I make six figures, maybe I should drive a car that's a few years older and it may not look as cool, but I'm going to have some savings in the bank, and I'll have an emergency fund. I won't be running out of money between paychecks. But see, that's also part of the low interest rates. People do not feel the need to save in such a low interest rate environment. And that's why I feel that this interest rate manipulation is really hurting the economy. Yes, people are foolishly spending, but people don't think it's that foolish when you barely get anything on your money for saving it. So, hey, let's go out and spend it, because in a couple years that car might be even more expensive. That house might be even more expensive. It's the FOMO. And this is FOMO that's going on for a long, long time. The longer they keep this propped up, the more people feel the complacency that this is the new normal, that things are not going to change. It's a permanently high plateau, and that's a dangerous place to have your mind in a bubble economy. So we'll continue to see how it unfolds. Thank you, everybody, for watching this channel. I appreciate you being here, and especially thank you for coming back after a few days off. Spent a few days out in the desert, Palm Desert actually, a little bit inland here in California. Out there, I saw a lot of people spending money. It was more of a retirement type of area. And I did see a lot of stores that were closed in a couple of the malls that we went to. And I think a lot of that is just the shift over to online. I don't think it's a sign of financial Armageddon. But also keep in mind, Amazon's been around for 20 plus years. It's not something new. So why now are we seeing so many stores closing, so many more compared to just a few years ago? All right, so it is something else we're going to keep our eye on here, as well as all the other red flags that are out there. And I'm actually at some in-laws' house right now, so sorry about the noise in the background. But thanks for joining me, everybody. Hope you're well. I hope you're staying above water, and really hope you're prepared for what's lying ahead of us here in this economy and this financial system. And hope to see you again here soon on this channel. Bye for now.